What's up, you guys? Steve here from the Ram Real Estate Investing channel, the channel where we talk about how to make money in real estate investing. And today we're going to be taking a look at a video that was released today by Ben Mallah. And I got to admit, I'm excited to take a look at this video because it's not often that you get to see someone worth $250 million through real estate investing break down the numbers on an investment property. And this video that we're going to be taking a look at today is entitled The Economics of Income Property Life for Sale. And I'm really looking forward to sharing this with you guys because he takes something that's just so complicated and daunting in most people's minds and just makes it really basic and simple and breaks it down really clear and concise. So let's take a look. You can tell that he's done this several times over. So without any further ado, let's jump right in and let's take a look.
All you need is a piece of paper, a pen, a calculator, a pack of Newports, and a lighter for a cigarette break.
Love it. So for those of you guys who don't know about Ben, a little bit of background on him. He was born and raised in Queens, and he's about 6'3", 400 pounds. Looks like the type of guy that if you owed him money and you didn't pay him back, he'd probably break your legs. However, he has had an immense amount of success in commercial real estate investing. Now, according to Google, he is worth around $200 to $250 million. He has owned one of the most expensive properties in Tampa Bay, Florida, and he owns the BATMOBILE.
Okay, here we go. You find a building, it's 10 units. It's 100 grand a unit they're asking. 100 grand a unit times 10 units is $1 million. You go to the bank, you tell them you want to buy the building. You want to borrow 80%. The bank loans you $800,000. Loan. 1 million from 800,000 is 200,000. That is your down payment. That's the structure of the deal. Clean and simple.
Couldn't agree more. Clean and simple. If you're looking to buy an investment property, typically the banks want you to come with 20% down. So in this case, if you're looking to buy $1 million investment property, you're going to need to come to the table with $200,000.
But you tell the bank, I'll borrow that 800 grand from you, but I want it at interest only for at least 2 or 3 years at 4% interest. The bank's going to cry, no, no, no. Eventually, it's okay, see you later. You'll find a bank that'll say yes. Sometimes you may even have to use a mortgage broker to help you if it's your first time, and they'll get it done. There's a lot of banks out there with a lot of money to loan, and as long as the property's decent and you're decent, they'll loan you that money and they'll work with you. Don't be afraid to try to bargain with banks. Everything is bargaining. There's nothing etched in stone in lending or buying real estate. Everything's negotiable. Don't be afraid to negotiate. You can always go up, but you can't go down.
So true. Now, I've been investing in single-family residential, but I've also been looking at commercial real estate, apartment complexes. And I was debating whether or not I should buy a bunch of houses or an apartment complex. And I actually found an 18-unit property, and I approached the bank, asked them for a loan on this property, and they were actually so pleasantly surprised by the numbers that they wanted to do the deal with me. However, after sitting down and really breaking down the numbers, I decided to go with the houses because the ROI looked like I had a lot more potential, and I could easily flip these or collect rents as opposed to the apartment complex. So I decided to go with them, but I didn't respond back to the bank, and they actually called me back later and asked me for a status update. And when I told them that I was not going to do the deal, they actually offered to lower the interest rate for me because they wanted me to do the deal. So it just goes to show you that if you are a real estate investor and you have a solid background, a history in making good investments, and you have a good deal, the banks actually want to lend you money. So keep that in mind.
Let's say everything works out. You got a loan. You buy the building for $1 million. You owe the bank 800 grand. You put $200,000 out of your hard-earned savings and money your grandpa left you or wherever it came from. And then you have 10 apartments paying you $1,000 a month. That gives you a monthly income of $10,000 a month, $120,000 a year. It should be less, but taxes, property taxes, meaning insurance, some sort of maintenance, some sort of management, utilities, pay the lawn guy, maybe there's a pool there, I don't know. I'm way over estimating at half of your income will go to your expenses, just to play it safe. That's a very safe zone you're in right now.
Now, I have to agree, if you're buying in the right markets, this sounds like a very conservative guesstimate in my opinion, because like I said, I don't own any commercial property. However, I do own single family residential, and in the areas, the markets that I buy for buy and hold, none of them have taxes, insurance, utilities, or any overhead expenses or anything like that, where the operating expenses are 50% of the gross annual income. So the NOI or whatever should exceed well beyond 50%. So I think that that's a safe guess, in my opinion.
$5,000 a month out of your $10,000 a month, which is your expenses, which is $60,000 a year. That's going to leave you the other half, $5,000, and another $60,000 is what you call your NOI, net operating income. But there's one person we can't forget. The bank wants their interest on their money. They make their living off of that 4%. You owe the bank $800,000 on that $1 million purchase. $800,000 at 4% equals 8 times 4, 32. You don't need a friggin' 6th grade education to know that one, because I never went past the 6th grade.
Wow, I did not know that. He didn't go past the 6th grade. You see, junior high and high school are not necessary to one day become a $250 million man.
8 times 4 is 32. $32,000 a year in interest. You're left with $5,000 a month or $60,000 a year. 32,000, now I need a calculator, divided by 12, you're going to pay the bank every single month $2,666 in interest only. I don't like 666, even though I don't believe in a devil. Let's say round it up to 2,700. Out of your $5,000 a month you're collecting, you're going to make a monthly payment to the bank of $2,700. Out of $60,000 a year, you're going to pay the bank, it's $32,000. Back to the calculator. $5,000 a month minus $2,700. You're left with $2,300 a month, or annually $28,000 a year. A month, a year. Yeah, I'll even give you an R there, and I'll give you an O there. All this for a $200,000 investment. Typically, a $200,000 investment, you'd be hitting a home run with any brokerage or anywhere if you got 10%, which is unheard of. That would give you only $20,000 a year. You're getting $28,000 a year. So $28,000 on a $200,000 investment, multiply that by, I'd say, it's not 10, it's going to be about 14%. 28 on the nose. You're going to get a 14% return on your money, baby. And the beauty of it too is, and please consult your CPA, that income, by the time you write off all your expenses and you write off the interest on your mortgage and you depreciate what's left over, all your tax will be deferred until you sell the property. And if you 1031, it even keeps getting deferred.
Now, for those of you guys who don't know what a 1031 exchange is, it's basically an account that when you sell a property, there's a way for you to defer the taxes or avoid them temporarily, where you put it into this account. This account is specifically for you to reinvest the money. Now, I believe the time frame is like 9 months. You have 9 months to reinvest the money, and all the money that you can take from that account and put into another similar property is totally tax-free. And you can continue to do that over and over and over, continually deferring the taxes, so you don't have to pay capital gains on it. So that's another strategy that real estate investors do, is they sell it and then they place it into a 1031 exchange account.
So that's real estate and a small average commercial deal of 10 units in a nutshell. Do it. Go find an agent, go find a broker, go find a bank. I don't care. If you got 200 grand laying around or you can scrape up, go find a deal. Make sure the units rent for at least $1,000 a month. Buy 10 of them. Check your expenses. Make sure they don't exceed the half of the rental income, and go buy the deal now. And once you get that one under your belt, you buy another one. And as rents go up, your income goes up. And always maintain your property, because a good landlord always gets his rent.
I'm gonna make my kids watch this every day.
Is the rent determined according to a percentage of the tenant's annual income? Well, in the open market, the rule of thumb is do not rent to a tenant unless they have a minimum of 2.5 times the rent in income to 3.
Yeah, now it's my understanding that 3 times the rent is pretty standard. All of the tenants that I have in my properties make 3 times the monthly rent.
If a person makes $1,500 a month, don't rent them an apartment for less than. Person comes into the office and says, I want to rent an apartment. If the rent is $750 a month times 2.5, that means they have to make $1,875 a month minimum to be able to afford the rent. And you better be careful, because that's really a slim margin there. Typically, if you rent a place for $750 a month, you want to see the person make 3 times the rent. So they should have a monthly income of $2,250. That's pretty the norm. But, you know, you want to be nice and you think the person has good credit and a good history and you can trust them, you can go down to 2.5. When I was desperate, back 20 years ago, when I couldn't find any tenants, I used to rent to people where half their income in California went to rent. But I was desperate, and a lot of times I was sorry I did it because I couldn't afford it.
Yeah, that's a tough one. You don't really want to rent to somebody that can afford it. You don't want to put them in a position where they might not be able to pay their rent. However, like he said, he was a little bit desperate. And it's kind of a tough one to call, because it's like, do you rent to this person that's here right now that, you know, might be having a tough time making the rent every month? Or do you hold out and take a hit this month to possibly get somebody that will qualify better the following month? So, you know, that's a tough one.
So 2.5 to 3 times the rent in income. That's basically it.
All right, so there's still about 2 minutes left. He talks a little bit about Section 8 and collecting security deposits from tenants. However, if you want to see the full video, I'll put the link down below. But that is, in my opinion, a really clear and concise, simple breakdown of an investment property for you. So I hope you guys enjoyed this video. Do me a favor, if you like this, hit the like button, hit the subscribe button, and be sure to turn on the notification bell so that way every time I upload videos, you can be notified. Thanks for watching. This is Steve. God bless. Make it a good one.